Good morning, everybody. Guten Morgen, as we're talking now in Germany, and I think unfortunately, as an analyst, it's a symmetry of data I want to present you. No, just some slides, but I think the slides were sent over to Richard 4 days ago, and yesterday we all saw the red banner with CNN, Skynet, and NTV, and wherever that Chancellor Merkel will step down. So she will step down step by step, whatever this means. We have no idea. But the tricky thing right now is who will follow her, and as she killed the last 20 years old man, like in Game of Thrones, as a chairman perspective, I say, who will run for that chancellorship? I have no idea right now, because we don't know nobody who will follow her, speaking a little bit brokenly. Anyway, starting with one of these impressive things, I think we're in a really good mood as an industry, and I think maybe most of you will take 2/3 of the turnover rate by end of this year, so this quarter, so we're really busy. But on the other hand, I think coming back to 15, Thomas, how long will this race going on? I said, well, 2 years. 16, what is that? What's a super cycle or is it ultra cycle? And my buzzwords vanished, because it's now in the 10th or 9th year on the super horse, starting with what we call the financial crisis situation after Mr. Lehman came up. But now we feel, I think it's much more than a gut feeling that obviously something will change within on the political level, but also on the ECB thing. Half of the managing director board of ECB will retire in October next year, which is also a story by itself. But I think there was right now no announcement by Mr. Draghi himself and all these employees that we don't expect something to happen on the street side by September. Just quoting him, I have no idea what will be in springtime when winter's over. Maybe there will be some first remarks on the ECB side. Anyway, I think for us it's more important that we will see again in the next 12 months as the, maybe call it solid or traditional route of cheap money, higher prices, and what you do within these things. I don't want to bore you with all these details, but I think there is one thing where Germans tend to be always a little bit pessimistic. Crazy. So what happened? 2 weeks ago, unfortunately this doesn't really work. We highlight the forecast for end of this year. This is the commercial transaction volume in Germany, which is an all-in. All-in is commercial in total, and we increased it due to one main reason. In Germany, maybe we'll have a discussion later on that, there is a discussion going on the share deal versus asset deal. And this was due to the effect which, as an analyst and as an economist, I like, which means these pulling forward effects. We face two huge transactions right now, especially in Frankfurt, where the Commerz Real, we can mention this, it was in the news. So we pull it forward due to the expected change in the asset management share deal. So what happened is, it's not a naive projection, don't get me wrong, but I think we wouldn't come over the 60 billion either this year, but I'm really convinced that it will go much more better than the last 2 and 3 years. But whether it's called plateauing or super boom, I have no idea, it's up to you, but this is of course an impressive situation. On the other hand, I think this is my main job. I try to look, speaking more seriously, I try to look for these super crazy stories from storytellers with cheap money buying property in Germany. And fair to say this, there are just few which don't convince me with their stories. So I wouldn't say this is all clear and sober, this is all rational, there's a lot of gray in between, but just dig a little bit deeper, you see that obviously most of the German markets, and the dominant factor of course always office, retail, industry, and then the mixed use factor came up. Maybe we can have a discussion later on. So the money stops at the end of the CBD. It's now going to the edge of the city, then it's called value add, and then there is the nothing. Which means, speaking in a big picture, we don't see a flooding of the huge capital in the middle of nowhere like we faced it in 2007 and 8, 10 years ago. And this is, there are more reasons by the way, but this is one of the main reasons. If you follow the money is so rational, in my honest little word, that you accept extremely high prices compared to history, but we don't go on the outskirts. So this is again where on one hand we can ask where does the value really comes from for the next years, whether it's the rental growth expectations, or is it the land price? I think for me it's much more a situation that we face more these, value of land gain. Whether it's a sober story, a rational story, or a crazy story, we'll see maybe in 5 years' time. And again, all these dots quoting here are RCA because they create these beautiful maps. When I mentioned this, I think you're all aware that Germany, we don't have that dominant center like London, UK. And we have, of course, Berlin, everybody loves, obviously. Then we have Munich and Frankfurt, where is my desk, but also the Rhine-Ruhr region, with Cologne and Düsseldorf and Hamburg. So wherever you go, this is, I think, one of the biggest untold story that it's so secure, solid rock in good and bad times. You know the story. But there are a lot of, and this is again a tricky thing for you, that we have 25 so-called secondary locations in Germany. You see that most of them are the red dots, or the orange dots on that. And this is again where, when I read a lot of headlines in PropertyEU every morning, I say, who is buying what? With a quote of 9%. If a UK-based company making investments in Münster or Augsburg, maybe you've never heard before, then it will, most of the part, it's not the direct investment, it's more part of the portfolio. And we are aware, especially the people who survived 2 or 3 cycles, which means at the end of the cycle, we see the big fat portfolios, which means Frankfurt, Hamburg, but also Biberach, Saarbrücken, and Heusenstamm, maybe. And this is again, we're coming back to my story, this is again, we don't see any flooding effect on the secondary third-tier locations in Germany the last years. I see the headlines, but the headlines are most driven by local investors, which is rational, and then parts of the portfolio starting last 2 years. And again, increasing the election market, we'll see what's going on, which is the A, sorry, let's go there, which is the so-called A locations and the secondary locations. It's what's an equal situation, so no dominant factor, whether it's A or whether it's the rest of Germany. Well, of course, if you are active in a fundraising business, everybody shows these. Show this slide because it gives you an indication on the comparison of the Treasury, 10 years Treasury bond, German bond, and what happened in the A and so-called secondary locations. Keep it in a nutshell. If there is a range between first and secondary locations, around 150 basis points, then the others say, that's okay, that's cool, that's perfect. Would not, of course, it's the property itself who create the value, but we don't see any things like going back in the maybe good or crazy years around 2000 where the yield gap between A and B was really close together. Maybe this is a part of the rational decision we made the last years. But again, we could have a discussion, of course, on that. And this is Germany as we see it, reality maybe. I spend right now, I'm just part of the German team, but running the research for Catella. And when I'm in Germany with international investors, my life is in the, let's say, red dot locations. We go there, but at the end of the market tour, at the end of the week, most of the international investors, they run for a little bit here. Munich, Berlin, Hamburg, Frankfurt, Cologne, Düsseldorf, full stop. We try to convince them to go more on the risk side, or value add, whatever. No, the market tours happened in Bochum, Duisburg, Karlsruhe, Dortmund, Essen, Dresden, Wiesbaden. It's a good day, it's a perfect lunch and dinner, but at the end of the day, the acquisition happened in the so-called A locations. Footnote, maybe also not on the list. The other ones, it's just more academic research paper, of course. You see that if you want to go to Solingen, which is on the top, you get that risk factor and this yield. But again, I think one of the main reasons why most of the investors stay, just talking on the core side, of course, there are more others. They stay in Munich because it's always the, let's say, they're scared of the exit strategy when something happens. So when you are in Solingen or in Düsseldorf, of course, you get really nervous when something changed on the interest rate side. I missed the transaction yesterday, the Trianon, one of the big towers in Frankfurt. You can see it here that this is the world which is new for me. I'm not as young as some of you in the room, but new for me, which I think we can have a discussion later on. In the good old days, there were no life under 5% cap rate or whatever, cross yield. Nowadays, we have to understand that it's 3 something, it's close to 2.9 something, and my best guess is that also after a change of the market cycle, we will never see these 5+, whether in good or bad times, for core super product. And these are the stories you tell us, and we tell you why to go to Munich, why we go to Düsseldorf, blah, blah, blah. This is not, of course, representative, but these are real transactions. So facing the numbers. Footnote, by the way, it costed a lot of conference calls and dinners to get all these numbers, because you know, Germany is, self-critically speaking, it's not a super transparent country. And so it's again, it was a lot of lunch getting these data. Okay, last slide. Maybe last slide. To come more or less to the discussion on that. Of course, the large money around for us, especially the institutional investors. I faced that the money flow meanwhile came especially from the US. The last 2 quarters in Germany. Expecting yield compression, no doubt. I see our rationality at the level of 3 something, not 2 something, except of retail and shopping centers, discussion later on. And again, there will be no dramatic change in doing things. What's not here, and that this is just one dot, housing sector will become increasingly on the radar of investors, which means from a more German perspective, the enlargement going back 10 years where some investors told us we have to go to become more international, Singapore, Tokyo, Seoul, and Italy becomes now the, let's say, contradiction, which means now we have to stay in the country and get more diversified in the other asset classes. I think this is the reason why the Germans are so astonishing, but also like these going in the housing sector, which is service apartment, which is micro living, shared living, all these living concepts, whatever it takes. And so this is again where the pressure comes out of this money bubble, of course. And on the other hand, I think we don't expect that will change something dramatically. On the other hand, I think we all hear these rumors and all these gut feeling driven, and well, winter's coming, can imagine, I think it's now 8 years, right? Game of Thrones, 8 years. Winter's coming every year. Okay, this winter is a long winter, by the way, but don't get nervous, because I think from your and my responsibility in the market, we should really focus more on these fundamentals. And the fundamental side, whether they're Miss Merkel's daily, whatever, absolutely solid, absolutely cool. If you want to see the hair in the soup, of course, if the prices, the rents especially, increase dramatically on the existing stock due to the lack of new product, which means developments, then of course we can have a long discussion. Is this a healthy evolution? But on the short term, of course, it's a fundamental situation. And again, winter's coming every year. And first of all, thanks a lot for your attention.